The only school that teaches you about money is the School of Hard Knocks. Until now.
You need to learn this business, and this is the time to do it.
Become an insider. So you have to know the rules before you get in the game.
Welcome to the Money MBA Podcast.
Have I got your attention now?
Where you'll learn how to be a master of money.
There's so many ways to make money today.
Let me show you in 2 seconds flat why the rich get richer and the poor get poorer.
Now here's your host, Jonathan Kutsmita.
Welcome to the Money MBA Podcast. Today's guest is Frank Jurs, or as you may recognize him as Occupy Wisdom, which is the handle or avatar he uses on Twitter. So Frank is best known for instigating conversations about really anything market related, especially in the crypto Bitcoin space. So of course we dive into that topic, but that's just the tip of the iceberg as far as where Frank and I go in this conversation. So I can't wait to share it with you. This is one where I hope we get lots of feedback, lots of engagement, because as you'll see it later on in the interview, Frank and I talk about doing another one in the future and potentially bringing on some of the people that he shares conversations with or shares debates with on a regular basis in the Twitter world. So check this one out. Be sure to stay to the end and give us lots of feedback, as you'll be sure to be returned and rewarded for that feedback, as Frank and Occupy Wisdom, as he goes on Twitter, never misses an opportunity to engage with his antagonist. So enjoy this interview with Frank Jurs, Occupy Wisdom. Let's get right to it. Frank Jurs, welcome to the show, or should I call you Occupy Wisdom, or any number of recent Twitter handle changes, but anybody in the Fin-Twit world would know you as Occupy Wisdom, and hopefully our listeners will follow you there. But
thanks for having me.
Hey man, it's a pleasure. I appreciate you coming on. I'm looking forward to some of the debatable topics that we'll have going on, and hopefully we create a little bit of stir from some of these communities. But
no doubt about that.
Yeah, definitely. So Frank Jurs is a pen name you were mentioning. What does it stand for?
So Frank is just a derivative word of the meaning freedom, and Juris is a Latin derivative, I believe, of the word law. So it's just a good pen name to use. Got it.
So tell us a little bit more about yourself. I mean, you're a little mysterious. You got a pen name and these ambiguous Twitter handles, but you're quite a vocal individual in the Twitter sphere.
Just a normal, average person that has done a lot of studying and reading over the years. And, I just have a passion for investing and money and understanding it. I'd say as a somewhat of a young person who lived through, the great financial crisis and seeing people's wealth evaporate in a number of months, I was intrigued by how that could happen. And I couldn't wrap my head around it at first, where, I had friends and family members that said that, in the span of 2 months, they saw 6 figures of wealth just completely wiped out after working for an entire lifetime. And even after doing years of study and research and reading and debating, it still doesn't seem possible that could happen. But, we all lived through it, so we all know it can happen. So that's really having lived through that time period as a young person and knowing people that were wiped out essentially financially after a lifetime of savings and hard work. It's just been a passion of mine to learn as much as I possibly can from as many people that I possibly can. And in the end, that's really what I think Twitter is good for, is a free education if you're willing to listen and provoke the right people.
Provoke is the key word, as you seem to be a master at that. It's an interesting story you share there. I feel like we've came from similar ashes. I kind of jumped down the rabbit hole after the financial crisis and seeing what it did to so many people, really so many unsuspecting people. And here we are 10 years later, and I don't think very many people are asking the right questions as to how we got from there to here. What are your thoughts on, in a quick form or summary of what happened in, 2009 window to where we are now, and has much changed in your opinion?
I don't think anything's changed. I think everything's actually gotten worse. And, I'm going to be borrowing a lot of insights, which you'll recognize from other thinkers and people that are much smarter than I am, especially, Nassim Taleb and, his works is insofar as fragility in the financial system and complex systems and so on. If you, just to go a little in depth with history without going crazy, we were pretty financial crisis free in this country. After we had some regular financial crises in 1907, 1914, obviously the big one in 1929. But after Glass-Steagall was passed and they separated commercial banking from investment banking and speculation, we really didn't have any financial crisis in this country of any significance until, the tech bubble burst. We came close in 1998 with the long-term capital management debacle with the derivatives and so on. But we were pretty much, we had our recessions, which are part of a business cycle. We had our slowing economic activity. We had our stock market go into bear markets and correct, but we never had any financial crisis in many decades, if you go back through history. So now we're seeing them with regularity. And I think, the repeal of Glass-Steagall had a lot to do with it. I think derivatives have a lot to do with it. I think of people not understanding risk from a probabilistic standpoint or a mathematical standpoint or any standpoint. A lot of the experts in this country that are used to manage risk use models that are obsolete. They use linear models. It's I think it's an ignorance of risk. And I don't think that any of the problems that appeared in 2008 has been fixed. And I think the fragility of the system is actually worse now. The derivatives books are bigger. The banks are more interconnected. It's more concentrated. I can't think of anything that has been solved since that time period whatsoever. Can you?
No, I think if you sum it up in a very simple manner, I think the issue was too much credit, too much debt, and they fixed the problem of too much credit and too much debt with more credit, more debt. Kind of to your point, there's greater counterparty risk because the system is even more concentrated, and you're starting to see some of that. Some of those concerns come out in places like the Deutsche Bank's stock price and some of the things that are going on there, as them in some cases being the poster child of the ugliness that can happen in this derivative market. Do you want to kind of explain a little bit more in layman terms derivatives and kind of how you see it and the role that it's playing in the market?
What's funny is in the movie The Big Short, and I can't really tell how accurate of a portrayal that was, but they had some pretty simple definitions of derivatives and complex financial instruments. Derivatives are just financial products that derive their value from underlying things. So, if two people have a bet going, you could have two more people betting on their bet and 1,000 more people betting on their bet. And as it goes, you think of it as like an upside down pyramid where even if there was only originally a couple $1,000s at risk in the originating risk, the derivatives on top of that create a much more risky situation based on the outcome of one event. So, with mortgages and you can speak to this much better than I can, but when you've had all these complex financial products built on top of mortgages, everything worked fine with those products as long as people paid their mortgages. And mortgages are, sensitive to interest rates. They're sensitive to people working and earning enough money to pay them. And if you have adjustable rate mortgages and people can't afford them, those derivative instruments are not going to exist if everything doesn't go well. And, something from reading history, that things don't go well. And we're always surprised when something blows up, but it happens with such regularity that nobody should be surprised by it. The XIV blew up in February of 2018 where, I don't really know the specific mechanics of how that worked, but I guess it was people betting on low volatility. And as soon as we had volatility, the product exploded and went to zero. So derivatives are, they're basically, I can't think of any other easy way to put it other than gambling on underlying risk and magnifying the risk. So you could have derivatives in the the value of quadrillions when the underlying is nowhere near that figure. So it adds risk to the system, and it's risk that people don't really seem to understand.
Yeah, I definitely think there's a disconnect between what is actually going on in the financial system and what people are actually investing or betting on. There's a significant disconnect in that. And the term I often use to kind of try to help people visualize it is the rehypothecation, where the singular piece of collateral is being used multiple times, where eventually when you have that risk event and there's a claim on collateral or everyone's scrambling to get paid, there's not enough pie to go around. And that's when you have this major contagion or fallout. And so what it really seems like is that we've kind of gotten to a point, again, in a very short window of time, where risk has gone out the door, where people are and this, I'm going to be careful that we don't go down a rabbit hole with this, but this is really, I think, a result of the Federal Reserve, where they have created, because of interest rate manipulation, a dislocation in the market where there's no longer that natural price discovery. So if you don't know what the true cost of risk is, how are you going to try to legitimately manage it anyways? And then it seems like everyone just has this attitude of maybe partly because of the derivatives market, partly because of Glass-Steagall, where now these commercial banks are now also investment banks. But do you feel like, to a certain extent, that they're playing the game in a way where there is no risk because they feel like they're too big to fail, or at the end of the day, they'll be bailed out again?
Well, there's a couple different things mixed in there. I think the one change from 2008 till now is a lot of the risk was shifted from mortgages and household balance sheets to corporate balance sheets and sovereign debt. Obviously, with the Fed coming in with quantitative easing and buying up a lot of those toxic products to the tune of $4.5 trillion, or I've seen estimates that go above 10 trillion. I don't really know which are reliable, but it was at least a quintupling of the balance sheet, which still hasn't been reduced. Risk does not get destroyed at all. Risk is always there. It's just, where is the risk and how did it shift? And 2008 was truncated by the central bank action, which, to their credit, it did stop the crisis, but it didn't prevent it from, it's not going to prevent it from playing out eventually under some set of circumstances that we probably can't predict. But the risk has been shifted. And in terms of risk assets, everything I've ever studied, every risk asset and every product is value and is derived from the 10-year treasury. So if you could manipulate the 10-year treasury yield by doing any number of things where the yield is kept too low, or it's modified in any significant way, every other risk asset is going to be deformed one way or the other off of that. And again, linear function. So you have interest rates that are at 5,000 or 6,000 year lows. That is not something that anybody living on Earth could possibly say how that's going to end up, because no one's been there before. We've never had negative real yield and negative nominal yields. I think the last article I read says the tune of $14 trillion in sovereign bonds yielding negative nominal yields. I mean, if you had said 20, 30 years ago that people would pay someone to take money away from them, nobody would believe that was possible. Nobody would believe anyone would do that. And here we are at $14 trillion in sovereign debt. That's a negative nominal yield. So how could anyone possibly predict with any certainty what that's going to lead to when the price of money or the price of credit, or however you want to look at it, is so deformed that I read something the other day that there are junk bonds now in negative nominal yield. What junk bonds are called high yield. How could you call something high yield and it be negative nominal yield? It's so deformed. The risk is so deformed. I don't think anyone could predict with any certainty what that's going to lead to.
All right, I want to pause it here, backpedal, because there's a lot packed in that as well. So first thing is kind of give a simple explanation of the difference between nominal and real when it comes to really anything, but in this conversation, interest rates. Okay, so assume you want to believe government numbers. I don't know, puts them out
PLS or whoever puts out the inflation numbers on the CPI. Let's say that we're going to just accept that it's 2%. I can make a lot of arguments why it isn't, but let's just say that it is 2%. Say you had a 2% interest rate and a 2% inflation rate. You have zero at that point. You have to net those out. So let's say inflation is actually 6% and a bond is yielding 3%. You're actually making negative 3%. That's a negative real yield. A negative nominal yield is when the yield is actually below zero. When now you don't even need to worry about inflation because you're already making nothing. So let's just say a bond is yielding 2% and inflation is 2%. All you're doing is keeping up. Let's say inflation's 6% and your bond is yielding 2%. You're actually making negative 4%. Well, we've gotten into the territory where the bonds aren't even a positive yield. The bonds are paying a negative yield. So let's just take inflation out of it. You buy a negative 2% bond. Every year, your money will be worth 2% less, guaranteed, which means you're investing your money with the explicit knowledge that you're going to be paid less in the future. And I don't know from history or anything how that can possibly turn out well, or how risk can possibly be managed with negative yield, real or nominal yield.
Well, with it being negative nominal, so straight out of the gate, you're guaranteed a loss. So the idea, it makes no sense, but the argument that someone might make for making that investment is that at the end of the day, they are simply looking for the cheapest way to get a return of their capital, not so much a return on their capital. And or it's pure speculation in that they think they're playing the Ponzi game where they think there's going to be someone foolish enough to pay more for that bond in the future than they pay for it today, whereas that capital gains or the profit that they make from selling the principal balance left on the bond is going to outrun the loss on the interest carry. Am I missing what might be the logical reason for someone taking a negative interest investment?
I can't understand why anyone would do it unless you're able to make your own money, print your own money where that it's not something that you worked for. Why would you guarantee yourself a loss? I've heard someone say it before. I wish I could remember who said it first, but they say the 10-year treasury is the risk-free rate of return. So whatever the 10-year treasury pays, that's your rate of return. You're expected for taking no risk. First of all, I don't know how you can possibly say investing your money somewhere for 10 years carries no risk. But let's just say that because, money can be printed, you'll always have a return of your principal, that it's risk-free. A negative nominal yield is a rate-free risk because you're getting nothing and you're taking a risk because there's no guarantee, implicit or explicit, as to whether or not bonds will get paid. Obviously, you can print money, but we all know what printing money leads to because there's been thousands of episodes in the history that shows you what printing money leads to. So I don't understand it. I'm not sure why it's happening. I'm not sure what it will lead to. I don't think anyone else does. And again, I don't think if you spoke to the world's experts 20 years ago, any of them would acknowledge that this was even possible, to the tune of $14 trillion.
So $14 trillion currently is the total amount of bonds circulating that are at a negative nominal interest rate or negative nominal yield, approximately.
Yeah, from what I remember reading, it could be different. I actually heard somebody reference 12 trillion and was corrected, and the number they were citing was a month old. So I could be wrong. It could be less. It could be more. But that's the figure that I heard in the most recent reading of it.
Part of the problem, I think, for most people who aren't necessarily students of the market and don't have a passion to dig deeper, is some of these numbers just seem like silly talk. I mean, you can't really put that into context. It's very difficult for the average person to even visualize what 1 trillion is, let alone 14 trillion. And that's a drop in the bucket in terms of the global bond market, but the amount of that dollar amount that's actually yielding negative is astonishing.
It's these numbers are so large that I don't think the human mind is capable of. Well, we're capable of understanding it, but the way I explain it to people is $1 trillion is 1 million billion. So you get a billion 1 million times. $1 billion is 1 million million, and $1 million is $1 million. So if we start with a million, we know, say the average person makes $50,000. Let's say that's 20 times their salary is $1 million. So then a million of 20 times the average person's salary is $1 billion, and then a million of those is $1 trillion. So these are numbers that are so big that it's hard to wrap your head around. So I use this example a lot to have people visualize $1 trillion. So student loans debt now is like $1.6 trillion. If you just do the math, 8th grade math, you can spend $1 million a day from the time the Iliad and the Odyssey was written in ancient Greece. If you spent $1 million a day from that period of time till now, you would not have spent as much money as was borrowed for student loans in the past 30 years. So it's, a picture what energy it would take to spend $1 million a day since ancient Greece or ancient Rome, or, the time of when Jesus was born, whatever you want to say, whatever historical marker you want to use. Just think of the energy it would take to spend $1 million a day, and you wouldn't even get to that number of what was borrowed just for student loan. And that's 1.6 trillion. There are other figures that are bigger than that. Like we mentioned before, the derivatives books are in the quadrillions, which are, I believe a quadrillion is 1 million trillion. So these numbers are, they're easy to throw around, especially when you talk about sovereign debt or unfunded liabilities of the government or the bond market. People throw trillion, billion around. No one really stops to think about the immensity of those numbers. They're astronomical numbers. They're so large that, from a practical purpose, I don't even know why you would separate infinite with them, because most Americans have less than $500 to their names. Now, imagine spending $1 million a day since the time of ancient Greece, and you wouldn't even get to what's owed in student loans. So they're numbers that are so big that they lose their power by just throwing the terms around.
They do, and as we're having this conversation, I can feel my heart rate increasing, because the significance of that, how frightening that will become when the reality of this, when the music stops and the reality of this game kind of comes to an end, and the whole thing kind of flushes itself out.
People are going to be very upset, and they're not going to understand what's going on. And as I sit here, I'm looking at a note. I have a $10 trillion note from the Reserve Bank of Zimbabwe from 2008 in my hand. And I always like to show this to people, because I'm a trillionaire, and I have $10 trillion right here. It says it. But what does that mean? I have a $10 trillion bill in my hand. What does it mean? It doesn't mean anything. And this is where large numbers become confusing, because when you hear of $10 trillion, you're thinking of US dollars. You can put the number 10 trillion on any number of things, and it loses its significance.
Well, and going back to this idea of why somebody would invest in really a losing venture. If, I came to you as a friend, or even just someone on the street, and said, "Hey, can I borrow $10? Next week I'll give you $5 back and we'll call it even." No one would take that trade. But this is what's going on an obscene level in the bond market. And, anyone who coining somebody an expert's a tricky game, but if you look at some of the smartest minds in investing, none of them would be able to make a case, nor would they make a case for why negative interest rates are a good thing or why one should invest in them. The ones behind the scheme, the ones promoting it, and certainly trying to build a narrative around why it's a good thing and how it's going to, eventually be positive for the economy and people, is the central banks, the bureaucrats, the ones that are kind of puppeteering this nightmare. And
I think the thinking goes that, and I think it's a misplaced belief that consumption-driven economies people need to spend money. So to offer low interest rates, it discourages savings. It discourages the hoarding of money, which I don't know anyone who's hoarding money, with the cost of living. So I don't know where it comes from. But anyway, I think it's the thinking goes, the conventional wisdom was always put your money into a savings account. It's safe. It will earn interest. You'll have more when you're older. And that's what, prior generations were taught. So it's still instilled in people now, have a savings account. But I guess by instituting negative yields, it encourages spending because the money will be worth less tomorrow than it is today. So let's just think at 2% inflation, let's say that was even real. Rule of 72 divided by 2% gives you 35 years. Your money's purchasing power will be cut in half in 35 years. So for every 10 grand you have today, at 2% inflation, it'll buy you the equivalent of what $5,000 will buy you today in 35 years, and that's at a 2% inflation rate. So maybe the thinking is get people to spend the money gets circulated in the economy, and you get economic growth due to consumption-driven spending, which, again, I think is debatable because I don't really think that's where economic growth comes from, or at least real growth comes from. But I think that's what the thinking behind it is to not have savings. We can debate whether or not people even have savings because I think it's pretty clear that most of the country doesn't. So I think people are pretty much spending their money anyway. So I don't know where it comes from. I just know that it's very hard to be a debtor, whether you're a corporation, a government, a person, a household, at high rates of interest. You're in the mortgage type business, or at least familiar with it. You would know that high rates of interest can make things way less affordable. At least in theory.
Yeah, I mean, there's a lot of ways to kind of go with it from here. I mean, first of all, the constant collapsing of interest rates, what it's really doing is, and this is kind of how all of this craziness seems to be pervade, but you're punishing the savers, not necessarily at the expense of risk takers, but at the expense of consumers. So you no longer have the motivation or incentive to save. That savings eventually becomes CapEx. It becomes the capital through which new ideas are invested and financed. Instead, you just kind of have this Ponzi financing game where it's just a race to zero. And we've seen that kind of erode the savers over especially the last decade. And that's, again, this just goes in so many different directions, but you start talking about employment. Are the employment numbers really real? The participation rates at record lows. You have people working longer than ever because their savings aren't generating the yield and cash flow that they need. So that's making it more difficult for younger generations to get into the workforce because people are staying at their jobs longer because their savings, if they have any, aren't generating any returns. That reality starts to sink in, and people start to go further out on the risk curve and investing in things that normally they wouldn't touch. And this isn't just individuals, this is institutions like banks, insurance companies, etc. And we talked about this earlier, at least you touched on it when we were discussing negative interest rates. You were starting to see things get very close to that, or the yield curve start to flatten out on high yield. And I wrote a paper, it's called The Truth About Mortgage Rates. It's intended to help people to understand these concepts and how they influence investors' sentiment, the bond market, which ultimately influences interest rates. But really, it was a piece to kind of pull back the layers on some of this so people can understand what should be very general and standard concepts like what is high yield, what is a junk bond, and why the heck are junk bonds trading at rates and levels below what used to be the norm for the quote unquote risk-free rate, which was the 10-year or is the 10-year treasury. And a lot of these things that seem to be kind of forming these mutations in the market seem to happen because people don't let go of their dogma or these ideas that no longer, they don't question them anymore. The 10-year being the safe haven trade or the risk-free rate, that maybe made some sense 30 years ago. But today, the U.S. is the most indebted country in the world, in history of the world. We're running deficits. we're basically inflating away the value of the dollar. That's part of why you're seeing interest rates where they are. And at the end of the day, people are still thinking the same way. They're not reassessing how the narrative has changed and what that means ultimately for their savings, their investments, and how they should go about, living their lives and trying to survive in this very financially complex environment.
Well, think about how I think the last time I checked, the Greek 10-year and the U.S. 10-year were paying the same rate of interest, which, the implication is that they're equally as risky, which is laughable. I think the U.S., being in the U.S., I think with all the problems, I think when you compare it to the rest of the world, people look at the U.S. almost as the safe place with all its problems, which is kind of counterintuitive. If obviously we are the biggest debtor nation. We have, a lot of, our debt to GDP isn't as bad as Japan or some other countries, but if you're, I hate to use this cliche, it's been used 1,000 times, but if you're the cleanest dirty shirt in the laundry pile, that's the one you're going with. And that seems to be what has happened over the years. What are the alternatives? There seem to be, 80% of the payments made in the globe are in dollars, and things are denominated in dollars. It's been the world reserve currency for many years, and who knows if that's going to change or not. But it's the interest rate. Something is broken in the bond market. You can tell when the Greek 10-year and the U.S. 10-year are yielding the same percentage or close percentages. You can tell something's broken because it's not supposed to be that way. Risk is supposed to be compensated. So the larger the risk you're taking, the more you're expecting to gain in taking that risk. So why would someone buying a 10-year Greek bond and a 10-year U.S. bond expect the same rate of return? It doesn't make any sense to me. There's a lot of unlimited examples of why the bond market is broken, but you have every bank doing their version of quantitative easing and asset purchases, and the U.S. was tightening, the rest of the world wasn't. It's going to get sorted out at some point, but who knows? There's no. I guess the main point to make is there is no way to predict what's going to happen. It wouldn't be predictable anyway, even if it happened in history, because there are too many variables to keep track of. But even it hasn't happened, so there's really no way to predict it. So trying to predict it is kind of a fool's errand. All you could say is, looking at the system, it's fragile and it's broken, and there's definitely a lot of problems with it because it just shows up in the numbers.
Yep.
In terms of interest rates, it's supposed to be you risk your money for a return. So, the conventional wisdom was go to the bank, deposit your money into a savings account. The bank will use it for all manner of loans to other people, and you are going to receive an interest rate which should be higher than the rate of inflation, or it would be purposeless. And you're going to get compensated over the years for the risk you're taking. Retiree in the 1980s could have deposited, a life savings of $250,000 into a perfectly safe savings account, and the interest they made on that could have probably supported them in a decent or at least average lifestyle. I can't think of how many millions of dollars you would need to deposit in a savings account to even get the same nominal interest payment, and you could never support yourself or your family on that interest. You could live on $30,000 in the 1980s. You could never live on that today. So something's broken. Savings is discouraged when really the basis of economic growth comes from savings and investment in that respect.
Right.
It's just very hard to untangle it and think of what the solution might be.
Yeah, I agree. There's lots of really good conversations on these types of topics, and I really don't know if there's a way to unwind the ball of yarn without, getting a ton of knots in there. And I think for a lot of people, the logical conclusion, or at least maybe the easiest one to come to sometimes, is that there's just some sort of reset. And it feels like that was something that should have happened in 2009. It didn't. The policy response, debatable whether it was the right one or not. I think the biggest issue with it was that there was no punishment for the people ultimately responsible for this. And to the point you made earlier, a lot of the risk has been taken off the private balance sheet, now swept onto the public balance sheet and the sovereign balance sheet. And so if we have another credit crisis, which is inevitable because of how our economy is structured, we need perpetual credit growth to avoid recession. And that's also impossible. You can do the type of manipulations that they're doing, but eventually you create this social unrest, which is the result that we're now seeing in the political and geopolitical landscape. And so they've completely distorted the risk. They've eroded out the middle class. They've punished the savers. And now people are scratching and searching for yield, which in many cases, I think kind of brings us to some of the things that we've seen born in this environment. And one of your favorite topics, I think, which is crypto-currencies. Yes. So I'm not even going to lead into it. I'm just going to pass the baton to you and let you have at it, because this is something that you're quite possibly the biggest antagonist in Twitter on, and not in a way just to stir the beehive, but you really propose some really profound questions for people to think about, and the response is oftentimes just emotional, and there's not a really good answer to some of the things you put out there.
There's lots to unpack with cryptocurrency. So I've always went into thinking of cryptocurrencies as a novice. I've read things, articles, white papers, books, listened to the debates, listened to the podcast. Part of provoking people on crypto Twitter is to see if any of them will come back with anything that's profound or worth thinking about. And a lot of it, again, is you get dogma. You don't get anything of any substance. And they say digital. The first argument I get is digital currency. We have digital currency, or we already had it. Then I get distributed ledgers. Okay, that's good. I think that's a good idea. Distributed ledger. You can't. It's immutable, and you can't edit it. I think that's a good idea. I think there's some merit to that type of technology. I don't understand how something that was intended to be a peer-to-peer transfer of value became a vehicle for speculation, where people think that by taking US dollars and buying $3,000 worth of open source Bitcoin code, that's going to entitle them to a luxury vehicle and living in a mansion and being rich and going to the moon or whatever other things that they want to do. It's distorted. It has all of the properties of a speculative mania. It doesn't have the properties of a sound money or a store of value or any of the things that money has been for 6,000 years. I understand the technology. I understand the thought process. I understand the instantaneous digital age that we live in and the convenience factor of it. Digital currencies are nothing new. Most of U.S. dollars are held digitally in bank accounts. Most of the transactions are done digitally. It's nothing new. I guess what was new about Bitcoin or any of the other cryptocurrencies was that you have this proof of work concept where every transaction is validated, and this gives people an incentive to mine, or what really just amounts to solving pointless math equations on a computer and wasting a bunch of electricity, so that this system can add blocks to a blockchain. And it's just a lot of technical jargon, a lot of technobabble, a lot of people using big words and big concepts to confuse other people. But in the end of the day, when you boil it all down, you see rampant speculation. You see all of the trappings of what a bubble is, and the bursting of a bubble and an echo bubble. I don't understand why anybody would value Bitcoin at $11,000 or $20,000 or $5,000 or $300. I don't know where the price is derived from. Really the debates I've gotten into have come down to a group of people that believe in a person named Satoshi, who they've never seen or know, or even know if their person's a real human being, coming up with this revolutionary product that's going to make everybody rich. And it's not going to take anybody any work, and they're just going to put their money into buying these electrons from anonymous people on the internet, and they're going to be rich. And there's nothing in the history of money or investing or finance that looks like this outside of other financial bubbles. So I like the concept of a secure digital mechanism to transfer value, but you need value to store. Something has to be valuable in and of itself to store value, to transfer value. And nobody has really made the argument to me as to why Bitcoin is valuable. I've listened. I've opened the conversation up. I've listened to a lot of intelligent people about it. And I don't see where they're deriving the value from. And I don't see how this arbitrary limitation of 21 million Bitcoin means anything, because you could have a limited supply of anything. And I use this example from time to time, is that there's a limited supply of ocean water on the earth. It doesn't mean that it's scarce. It doesn't mean that it's valuable. Limit doesn't mean anything. It just means that there's a limit, and most things are limited. Scarcity matters, but scarcity only matters if the underlying object that is scarce is also valuable, which means it has utility, which means that it has to be valuable outside of a measurement of fiat currency. One of the things I like to propose to Bitcoin people is I would give them as much time as they need, come up with a 30-year term life insurance policy denominated in Bitcoin to be paid at 30 years from now with premiums paid in Bitcoin. And you tell me, without using the US dollar, the euro, the yen, any fiat currency, tell me how you're going to structure a financial product, contract, or any long-term instrument denominated in a cryptocurrency. You can't. You could never predict what Bitcoin will be valuable, what the value would be, or the market value would be 30 years from now. But you do this in US dollars all the time. People take life insurance policies, they sign long-term rental contracts, leases, commercial leases. There's a liquid bond market that we've spoken about. So you can denominate things in dollars. And even if you don't understand inflation, you can still understand what you think the value might be a decade down the line. I don't see that with cryptocurrency. So going through the characteristics of money is it a store of value? I don't think it has value to store, and I don't think it stores it anyway, because volatility is really the absence of the stored value. So it doesn't win there. Do people use it to transact? I mean, I don't know any real merchants that accept Bitcoin. I know people will accept dollars once Bitcoin's converted from in BitPay from Bitcoin to dollars. So I don't see it being used as a medium of exchange. I don't see it as a store of value. It's a very fragile system. It's full of counterparty risk. You need access to either the internet, electricity, digital devices. You need access to, they say Bitcoin can be transmitted through satellite. These are all systems that are great when they're working, but are completely terrible when they stop working. Nassim Taleb, in a few of his interviews, have brought up being in New York during the blackouts in 2003. And, because we relied on technology to make our sinks work, he couldn't wash his hands when there was no electricity, which means we couldn't even get water to wash your hands. So technology is great when it's working. The minute it stops working due to any number of events, makes it completely useless. If I'm here on the East Coast and went through Hurricane Sandy, if you didn't have physical cash, you didn't eat, you didn't have water, you didn't have gasoline. Nobody took credit cards. Nobody took debit cards. There was no form of transaction in digital form. And this is one of the things that I say, to the crypto community, is that when everything's working perfectly, your system might be great. But you just take one variable, one counterparty, one point of failure, and does it work? Will people transact in it? I don't see that happening. What are your thoughts, John?
Break it down for us again. What makes sound money? What are the 4 or 5 elements that are critical for that to be considered money?
So I look at it like it needs to be a unit of account, right? Which means, a unit of account. A dollar bill has a 1 on it, a 5 is a 5. It needs to be fungible. $5 in my pocket, 5 singles in your pocket, it's the same thing. It needs to be durable, which, that's where fiat money, again, when it's not representative of real money, kind of fails because paper money is not durable. It tends to break down. It needs to be portable. It needs to be a store of value. It needs to be a medium of exchange. It needs to be many different things to be a good money, which is why a variety of commodities throughout history have been used as money and have, through the free market, been rejected as money. A lot of the crypto community likes to bring up seashells or beads or feathers. Yes, those were all used as money at some point in time, but they don't pass the test for all the characteristics needed to be a good money, which is why they were rejected by the free market, and it's why I can't take feathers and trade for them anymore. If you have something that's a unit of account, you have something that's divisible, you have something that's portable, you have something that's a medium of exchange, which, the medium of exchange means that I don't have to trade directly with somebody for something. If you sell chicken eggs and I sell oil, I don't have to come up with an idea of how much oil you would take for chicken eggs and whether you even want oil. I don't have to convert it. I would have to convert it into something that's a good medium of exchange so that item is liquid among all people transacting. And that should have a stable value. It shouldn't have a volatile value. It should be stable, and it should be something that is stable over a long period of time. Money, in my opinion, is just a promise. It's a promise. That's all it is. It's a promise that if you store it, if you work for it and you store it, it will retain the same properties and will retain the same purchasing power it had when you earned it. It shouldn't be something that degrades in value. It shouldn't be something that degrades in its usefulness. Sound money was something that people were looking for throughout civilization, and the free market chose, silver and gold. That's what was chosen as sound money. As we've gotten off of those type of standards and moving to a floating exchange rate or fiat standard, people have now, in the technological age, have been trying to reinvent the wheel that has already been there for 6,000 years. And, I think in some respects they're doing a good job, and in some respects they're failing miserably. So I don't see many cryptocurrencies having those characteristics. And again, when you get into debates with people, they say it's an immature system. It hasn't matured yet.
Right.
I guess time will tell if that's true, but it has been a decade. And I just see most cryptocurrencies being a vehicle for speculation, a vehicle for gambling, and as a side effect of what we just were speaking about, when you have a financial crisis where there is a lot of liquidity and a lot of risk taking and a lot of people being forced to take very massive risks to get a return on their money, you see types of behavior like this. But I don't see it as a sound money whatsoever.
Well, how would you define the difference between money and currency?
So currency only exists because it represented money. So through the free market, silver and gold globally, not in the US or Canada or the Western world, but globally, this is Egypt, this is Greece, this is Rome. Those metals were chosen as money because they are legitimately scarce and they are durable and they are divisible and they are a medium of exchange globally, as I said, globally liquid, and they were portable and they retain their value, which is, the main thing is the purchasing power of them. So the one downfall of them is they are not convenient to carry around. I mean, things can be debated about that in terms of whether they're convenient or not, or they're too heavy or bulky or, convenient to carry on one's person. But currency was basically a derivative of money. So the money was stored somewhere in a secure place, and currency was issued against it, which functioned as a claim check. So next to my, Zimbabwe note for $10 trillion here, I have a gold certificate from, let me see what year this is from 1922. So it says payable to the bearer on demand, $10 in gold coin. So this piece of paper that I'm holding is pretty and it's beautiful. It's a work of art, but it is not this isn't money. This is currency. And it was issued against money. And it was a claim check on money. So you would take this piece of paper and you'll be able to go to the treasury. You were able to get money for it. But because it was paper and because it was pretty and because it had security features, it was used as a medium of exchange. So people knew that when they transacted in this, if they wanted to redeem money for the currency, that they were able to do it. I compare it to a car valet. You know, you go to a nice restaurant, you drop your car off, you get a valet ticket. You know, that ticket doesn't mean anything. It's a piece of paper with a number on it. It's not valuable, but that piece of paper redeems your vehicle, which might be worth $50,000. So the vehicle is the money and the claim check is the currency. You can say the same thing for a dry cleaner. You know, go drop off a, Burberry coat to your dry cleaner. They'll give you a little piece of paper. They have the coat, they have the value, you have the paper. When you return that claim check, you got your valuable coat bag, which is how a medium of exchange works. Currency was created to stand in for money. And a lot of the crypto people have a problem with money being centralized. And that's why they like decentralized distributed ledgers. And there's something to that and there's something to be said for it. But just about everything in our life is centralized. I mean, where do you get your water from? Where do you get your food from? Where do you get your clothing from? These are all central places. I mean, if the water company doesn't provide water, there's very few places you can go to get it. So we have trust in third parties in every area of our life. So the point about cryptocurrencies being trustless, although I could debate that, till the cows come home, we as human beings trust each other for so many different things. We go to the hospital, you go to a doctor, you're placing trust in other people all the time. You go to a restaurant, you eat the food that they prepare, there's trust there. Human beings have always had trust. They've always trusted third parties. It's not something new. It's not something outrageous. So I don't really understand the attraction to the trustless, other than throughout history, the trust has, I guess, been eroded through people making, lies and not having what they said would back the currency. And, there are historical episodes of that trust being eroded and not being true. So I can kind of see where they're coming from in that respect. But currency just came about as a result of it being a claim on money. And through the years, it didn't matter because it became the money. So now you transact in paper. And really the only thing that gives that paper value is the confidence that that money will provide for you if you exchange it for anything else. Confidence is much more fragile when you're using something that is valueless, like a piece of paper, or, in terms of the US dollar, it's really just made of cotton and linen. We have confidence in that. I have confidence that when I hand $30 to my landscaper, he's going to be able to take that $30 and buy groceries with it. As soon as that confidence is eroded, that's when you start having problems. And sound money kind of was the solution to that, because people had decades and decades and decades of confidence.
So we're going to take a quick break here. I've been talking with Frank Jurs, Occupy Wisdom, and currently on Twitter as Stack_Capital. We've been covering certain aspects of the capital markets, the derivatives market, the bond market, and I'm really excited where we go in part 2 of this interview, where we dive into cryptocurrencies. So take a quick break if you need. Otherwise, let's jump right into part 2 of this episode, or this interview, with Frank Jurs, Occupy Wisdom, and currently on Twitter as Stack_Capital. So let's get going.
Thank you for listening to the Money MBA Podcast with your host, Jonathan Kutsmita.
It's also my pleasure to see to it that decent, hardworking people in this community aren't robbed blind by a pack of money-mad pirates.
To access more great content, visit us online at moneymba.com.
That's where the money is. And more than that, control.
There's only one person in the world to decide what I'm going to do, and that's me.
And I am deadly serious about that. That's it, I'm done.